A $12,000 Roth conversion in 2026 could cost you $4,188 more than you expect, and the tax code won't tell you that up front. Most people running these numbers are only looking at one piece of the picture. They calculate what they'll owe in federal income tax on the converted amount, subtract what they'd pay on future required minimum distributions, and call it a day. That math isn't wrong, it's just incomplete. And incomplete math leads to expensive mistakes. I've sat across from too many couples like Linda and Dave who pulled their hair out over conversion calculators that ask for 12 different logins. Linda is 62. Dave is 64. They're both still working part-time consulting, pulling in about $62,000 a year combined, and they've got $850,000 sitting in pre-tax retirement accounts. They're planning to retire at 66, and they wanted to know, should we start converting now? They found a Roth conversion calculator online. They plugged in their numbers. The tool told them a $12,000 conversion would save them money in the long run. So they were ready to move forward. What the calculator didn't show them, what almost none of these tools show, are the hidden costs that get triggered the moment your income crosses certain thresholds. Medicare surcharges, more of your Social Security becoming taxable, a second layer of federal tax that kicks in at a level most people never see coming. The bigger problem isn't that Linda and Dave almost made a costly mistake. The bigger problem is that there's no free, software-free way to calculate the true cost of a Roth conversion, until now. We're going to break down exactly where most near retirees get tripped up, and then I'll show you a 5-step checklist to figure out whether a conversion actually works in your favor. Here's the trap most near retirees fall into. When you do a Roth conversion, you pay income tax on the amount you convert today. In exchange, you don't pay tax on that money or its growth when you take it out in retirement. The simple math says, if your tax rate today is lower than your future rate, converting makes sense. That logic is sound. The problem is that income tax is only one of the costs that gets triggered when you convert, and the other costs don't show up in your tax bracket. They hide in your MAGI, your modified adjusted gross income, and they can quietly add thousands of dollars to what you actually owe. Think of MAGI as the number on the tax code's radar. Once your income crosses certain thresholds, it doesn't just push you into a higher bracket. It triggers what I call identity protection lines, income levels that activate secondary costs most people never anticipate. Let's look at a concrete example with a single filer. Say you're 63. Your MAGI is $50,000. You collect $24,000 in Social Security, and you decide to convert $12,000 from your traditional IRA. That conversion pushes your combined income up by $12,000. Because of the way Social Security taxation works, that additional $12,000 in income causes an extra $8,400 of your Social Security benefits to become taxable. At a 12% federal tax rate, that's an additional $1,008 in federal tax, on top of the $1,440 you already owe on the conversion itself. So your real cost isn't $1,440. It's $2,448. The conversion just became 70% more expensive than the calculator showed. And that's before we talk about Medicare. In 2026, the IRMAA threshold for single filers sits at $106,000, according to the Centers for Medicare and Medicaid Services. A single filer with income already near that line, say $95,000, who converts $12,000 crosses it. That triggers a surcharge on Medicare Part B and Part D premiums that adds hundreds of dollars per year. And because of the 2-year look-back rule, those higher premiums don't show up until 2028, long after the conversion feels like ancient history. These aren't edge cases. Social Security taxation affects the majority of retirees who have any meaningful income from pensions, part-time work, or investments. IRMAA affects more people every year as the thresholds stay flat while incomes grow. Linda and Dave aren't in the single filer scenario, but the mechanism is the same. Their $62,000 in consulting income, combined with projected Social Security, means any conversion they do gets layered on top of income that's already pushing against certain thresholds. A $12,000 conversion that looks simple on the surface could quietly increase the taxable portion of their Social Security and move them closer to IRMAA territory in future years. This is the trap. Not bad intentions, not a broken system. Just one piece of math presented as the whole picture. Even when you know to add up all these costs, you still need a framework for weighing them against what you'd actually save on future RMDs. That's exactly what we're going to build. I used to think everyone needed professional software to model Roth conversions accurately, until I built this checklist for a client who refused to pay for a $300 planning tool. Turned out, all the key numbers you need are already sitting in documents you either have or can get for free. The software just automates calculations you can do by hand in about 20 minutes. So here's the 5-step checklist. No logins, no subscriptions, no email gate. Let's walk through it using Linda and Dave's actual situation. Step 1. Pull your current MAGI from your most recent Form 1040. For Linda and Dave, that number is $62,000 from their consulting work. Step 2. Estimate your projected RMD at age 75. Take your current pre-tax balance and multiply it by 4%. Linda and Dave have $850,000 in pre-tax savings. Their estimated RMD works out to about $34,000 per year. Step 3. Calculate the maximum amount you could convert without crossing the IRMAA threshold for married couples filing jointly. In 2026, that threshold is $218,000, according to the Centers for Medicare and Medicaid Services. For IRMAA purposes, Linda and Dave's relevant income, their other income plus the taxable portion of their Social Security, comes to roughly $114,000 before any conversion. That gives them more than $100,000 of room before hitting IRMAA. A $20,000 conversion keeps them well clear of that line. Step 4. Calculate the hidden costs of that conversion amount. IRMAA isn't a concern here. The net investment income tax threshold is $250,000 for married filers, so that's not a factor either. What does happen? The additional $20,000 in income pushes more of their Social Security into taxable territory. Because they're already collecting substantial benefits, only a portion of the increase flows through, roughly $9,300 of additional taxable Social Security. At a 12% federal tax rate, that's about $1,116 in extra federal tax. So the total cost of a $20,000 conversion is $2,400 in income tax on the converted amount, plus $1,116 in hidden Social Security tax, roughly $3,516 all in. Step 5. Run the net benefit formula. How much annual RMD tax do you avoid by converting now, and how long does it take to recoup the upfront cost? A $20,000 conversion reduces Linda and Dave's pre-tax balance by $20,000, which lowers their future annual RMD by about $800. At a 12% tax rate, that's $96 per year in tax savings once RMDs begin. Divide the $3,516 upfront cost by $96 in annual savings, and the break-even point is about 37 years. Verdict: at their current income level, a $20,000 conversion doesn't pencil out for Linda and Dave. The math isn't close. But this is exactly why the checklist matters. It's not that Roth conversions are bad for them. It's that the right conversion amount in the right year with the right income configuration can produce a very different result. A smaller conversion in a year when their consulting income is lower, or after Dave reduces his hours, might break even in a decade instead of 4. Skip this framework and you're guessing. And over 5 years, guessing can cost you $10,000 or more in unnecessary taxes and surcharges, money that was supposed to fund your retirement. But even with this formula in hand, there's one question that comes up almost every time. What if tax rates go up in the future? It's a fair concern. And history actually gives us a useful answer. People worry about future tax rates for good reason. Congress has changed them more than once, and those changes weren't small adjustments. The 1986 Tax Reform Act cut the top federal individual income tax rate from 50% in 1986 to 28% by 1988. The 2017 tax law brought the top rate from 39.6% down to 37%. Those aren't rare events. They're part of a pattern. Tax rates in this country have gone up and down multiple times in a single generation, often with limited warning. And while the 37% top rate remains in place for 2026, nothing stops a future Congress from changing it again. Now consider the time frame. According to SSA life expectancy tables, a 65-year-old woman in 2026 can expect to live another 21.6 years on average. That's more than 2 decades of exposure to whatever tax environment Congress decides to create. For a couple like Linda and Dave, that's a long runway, long enough that 1 or 2 major tax law changes are entirely possible. This doesn't mean you should rush into Roth conversions because rates might spike. That's a fear-based decision, and fear-based decisions often cost more than the risk they're trying to avoid. What it means is that the conversion question isn't just about this year's bracket. It's about whether locking in today's rates makes sense given how long you might be paying taxes in retirement. For people already in high brackets, close to the 37% top federal rate, the math often does favor converting. For couples like Linda and Dave, who are in the 12% bracket, the picture is less clear. Their future rates depend heavily on how much of their income comes from RMDs, Social Security, and other sources. Historical data can help frame the risk, but it won't account for a market crash next year or a spouse dying earlier than expected. That's where stress testing comes in. The 5-step framework works in a stable environment, but retirement isn't always stable. 2 scenarios come up repeatedly in real planning conversations, and both of them change the Roth conversion calculation in significant ways. The first is a market downturn. If Linda and Dave's IRA drops 15% in 2026, not an unusual event in any given year, their $850,000 balance falls to roughly $722,500. A $20,000 conversion in that environment means they're moving more shares into the Roth account at a lower price. When markets recover, that growth happens tax-free. So a down market is actually an argument for converting if the net cost math still works. It's one of the few situations where a short-term loss creates a long-term opportunity. The second scenario is harder to talk about, but it matters more. What happens if Dave dies at 70 and Linda is left filing as a single taxpayer? As a widow, Linda loses the wider married filing jointly brackets. Single filers hit the 22% bracket at roughly $48,000 in taxable income. If Linda's RMDs are large enough, especially as the account keeps growing, her total taxable income could push past that threshold, and she pays a meaningfully higher rate than she would have as a married filer. That's the widow's tax penalty. It catches a lot of surviving spouses off guard because it's invisible until it hits. But if Linda and Dave had made moderate Roth conversions over several years before that point, they would have reduced the pre-tax balance. A smaller IRA generates smaller RMDs. In that scenario, Linda's annual RMD as a widow could stay below that 22% threshold, keeping her in the 12% bracket instead. Over the years that follow, that difference compounds. It's not a dramatic number year by year, but over a decade, it adds up to real money. You can't predict when these situations will happen, but you can run the numbers now so you're not making decisions in crisis mode later. Even with all of this, most people still put off Roth conversions, not because the math doesn't work, but for a different reason entirely. Most people understand at some level that they should be looking at this. They know tax brackets change. They know RMDs start eventually. They've heard that Roth conversions might help, and they still don't do anything. It's usually not about not understanding. It's about the same mental move most of us make when something feels complicated and not urgent. We tell ourselves we'll deal with it next year, after the kid's situation settles down, after the consulting project wraps up, after we get a better sense of how much we'll really spend in retirement. Next year keeps moving forward and the window keeps narrowing. For couples in Linda and Dave's bracket, the 12% federal tax rate in 2026 is genuinely one of the lower windows they may see for the rest of their lives. Once RMDs kick in, for Linda and Dave's birth years, that's age 75. That income gets layered on top of Social Security, potentially pushing them into a higher bracket whether they planned for it or not. Every year they wait to assess the conversion question is a year of potential tax savings they can't get back. I don't know every detail of your financial situation, but this micro shift works for 90% of the couples I work with. Don't try to figure out the full 5-year conversion strategy all at once. Just do step 1 in the next 30 days. Pull your 2025 Form 1040. Write down your MAGI. That's it. One number. Once you have that number, the rest of the checklist has a starting point. And a checklist with a starting point is something you can actually finish. Once you get past that first step, the rest of the framework falls into place. Here are your exact next actions. Here's what to actually do in order. Step 1. Pull your 2025 Form 1040 and find your MAGI. This is your baseline. Everything else in the checklist builds from this number. Step 2. Pull your most recent 401k and IRA statements. Add up the total pre-tax balance across all accounts. This is what drives your future RMD calculation. Step 3. Go to the SSA website and use the benefit estimator. You want to know your projected Social Security benefit at your planned retirement age. This number affects how much of your income will be taxable, and by how much a conversion would shift that. Step 4. Run the 5-step checklist we walked through. MAGI, projected RMD, IRMAA headroom, hidden costs, net benefit formula. The free checklist is linked in the description. No email required. Step 5. If the math works in your favor, complete any conversions you want taxed in 2026 by December 31st, 2026. A Roth conversion is taxed in the year it's made, so the calendar year matters. Here's something worth knowing before you do that final calculation. In 2026, there's a new senior deduction, $6,000 per person for qualifying taxpayers, phased out at $150,000 MAGI for married couples filing jointly. This comes from the One Big Beautiful Bill Act, signed into law in 2025. Linda and Dave, with their MA of $62,000 and a $20,000 conversion, would land at $82,000, well under the phase-out threshold. They'd qualify for the full $12,000 deduction between both of them. That deduction reduces their total taxable income by $12,000, which at a 12% rate saves $1,440 in federal tax, an amount that can meaningfully change the net benefit math on a conversion they were considering. Not everyone qualifies, and the phase-out matters, so run your own numbers. But if you do qualify, factor it in before you decide. If you want to see more retirement planning breakdowns like this, no jargon, no sales pitch, just the actual math, subscribe to US Investor. New videos go up regularly, and the checklist in the description is updated for 2026. But even with all 5 steps done, there's one group of people who should probably skip Roth conversions this year entirely. We'll cover that next. There are 2 ways most people approach Roth conversions, and they lead to very different places. The first path, convert, based on incomplete information. You run the federal tax math, it looks favorable, you move money over, and then 2 years later your Medicare premiums spike because of IRMAA, and you're paying more in Social Security taxes than you expected. Over 5 years, that can easily add up to $10,000 or more in costs you weren't budgeting for. That's $10,000 that was supposed to cover healthcare bills, home repairs, or help out a grandchild. Gone, not because retirement went wrong, but because the planning was incomplete. The second path, use the 5-step checklist. Convert only when the net benefit is genuinely positive, after accounting for IRMAA exposure, Social Security taxation, and every other income-linked cost. Skip the conversions in years where the math doesn't work. Preserve that money for the things retirement income is actually for. The difference isn't just financial. It's about having options. Retirement quality of life depends on having income that's predictable and protected. A Roth conversion done right adds to that. One done without the full picture quietly erodes it. Roth conversions aren't about optimizing taxes as an abstract exercise. They're about keeping more of what you've saved so you can use it the way you intended. Let's bring it back to what actually matters. Roth conversions can be a genuinely useful tool in retirement planning, but only when you know the full cost before you commit. Federal income tax is one piece. IRMAA surcharges, Social Security taxation, and the net investment income tax are the others. Missing any of them means you're solving a puzzle with pieces missing. The 5-step checklist we walked through today doesn't require software, paid consultations, or a finance degree. It requires your Form 1040, your account statements, and about 20 minutes. You come away knowing whether a conversion makes sense for your situation, not someone else's. For some people, especially those in high brackets or with very large pre-tax balances, converting makes strong financial sense right now. For others, like Linda and Dave at their current income level, the math is tighter and smaller or delayed conversions may serve them better. The point is that both answers come from running the numbers, not from a rule of thumb. If this kind of practical, no-nonsense retirement planning is useful to you, subscribe to US Investor. We break down real decisions that real people face in retirement without the jargon and without the sales pitch. Every video is built for people who want to understand the math before they make a move.